Hey there. Welcome to part 3 of our series, the M4 Principle, the 4 essential top level strategies that you've got to employ to create and maintain wealth. What are the 4 strategies? First off, manage money. Number 2, make money. Number 3, maintain money. Number 4, multiply money. So today we're talking about number 3, maintaining money. Now, if you joined us for parts 1 and 2, you'll notice that I've changed the name of number 3. Number 3 is now maintain. I used to call it manipulate. Now, manipulate just means to handle skillfully. But my team got together and said, hey, it has some negative connotations. Can you change it? I said, sure. Let's figure out a word that starts with M that'll work, and maintain. It does it. It does it for us. So today we're going to talk about maintaining wealth. Now, when you maintain something, what are you doing? You're protecting it. Well, Roger, who am I protecting my money from? Okay, 2 very unique places here. Number 1, you're protecting it from those that want to sue you. And number 2, you are protecting it from those who want to tax you. Yeah, so let's get into this. I can literally talk for hours about this subject because, hey, this is what I do all day, every day. In fact, I've got a book coming out. That book, our working title is You Made It, Now Keep It. And I've also got a webinar that we're about to launch. It's from our last seminar that we did back in November that talks all about the Entrepreneur's Guide to protecting your assets, tax-free wealth, and reduction of taxes. Those 3 things. If you're interested, just leave a message down in the comments below, and one of my team will reach out for you with how you can acquire the book or how you can attend the webinar. All right, so let's get into it today, and we're going to go straight to the whiteboard.
Okay, guys, we're going to get into the basics. And I'm going to go ahead and remind you that there's a wealth of free education on our channel. So there are much more details to the basic strategies that we're going to talk about today. I go much more in depth on other videos, so be sure to check that out. So the first thing that we want to do is we want to protect ourselves from those that want to sue us. So that means we're never going to operate naked, meaning without what? A limited liability company, an LLC. Well, Roger, what about a corp or an Inc. or whatever? There's different people have different tactics. I like the LLC because it is flexible. And when we get to the tax portion of today's talk, I'll explain just how flexible it is. But in general, I want you to have a limited liability company. Now, there are some steps here, though, that you need to know. Okay. First off, asset protection, protecting your business. What's the first thing you're going to do? Number 1 is be a good business person. So be good, like E.T. said. You're going to operate ethically. You're going to treat people with respect. That's the first step. You know what number 2 is? Insurance. That's right. You can't fix stupid, but you can insure against it. Now, what kind of insurance? Well, you know what? It might be liability. It might be E&O, errors and omissions, depending on what you're doing. You might want to carry something like I do called professional liability. Or it might be construction insurance. Well, Roger, I don't really need insurance, do I? I mean, I'm an interior designer. Well, if you're an interior designer, do you go into your client's home? What happens if you break something? What happens if that something that you break is great-great-grandma Nancy's urn that contains her ashes? Now you got a real problem, and you better have insurance or you may not be in business much longer. What's number 3? Number 3 is that LLC that we just talked about up there. Okay. And number 4 is called umbrella insurance. Now, people always ask me, how much umbrella should I carry? You know what? Different amounts at different times in your business life. When you're starting out, you might want $1 million worth of coverage. And guess what? That's not very expensive at all. As you go along and you are accumulating more assets and more wealth, you increase that umbrella coverage. What's it there for? If it gets through your business insurance and your LLC, now you've got a backup plan so these people are not getting to your personal money. That's what it's there for. Okay? Now, what if there's more than one owner of my business, Roger? Well, you know what? That's called a partnership. And congratulations, when you're in a partnership, unless you have, once again, an LLC around this partnership, you will be personally liable for all acts of the partnership and your partner, whether you knew about them or not. So, quick tale. An old friend of mine, when I first moved to the state of Georgia to be the controller for a construction company, he came to us to work as a project manager. Why? He had had his own business. Well, what happened? He had a business partner, and he and the little girl, or the partner that is, and the little girl at the bank started having an affair, and they absconded to the Cayman Islands with all of the business's money. So my friend was stuck paying back $1 million in liabilities. Yeah, he didn't, it's not his fault the money was taken, but he's responsible for it. Whereas if this was in a limited liability company, he would be limited to what? His investment. Boom. Now, I'm going to talk a little bit more about partnerships when we get over into the tax side. All right. Now, remember, these are the absolute basics of protection. You should always talk to your trusted professional advisor. And if you don't have one, reach out to us. We'll be happy to talk with you and bring you on board as a client. Or if we can't help you, we can certainly refer you to someone who can. So let me ask you a question. What is the top expense in most businesses? In small business, it is most often taxes. Now, if you have employees like I do, it may be your payroll, but taxes are most often the number one. And if you don't set your business up right, they can be from 43% of your net income up to 50 plus percent if you live in the wrong state. So you always have to start with the number one tax saving strategy, and that is proper tax entity. Well, what do you mean tax entity, Roger? I'm an LLC. How many people have walked into my office and I say, okay, how are you set up for taxes? Well, I'm an LLC. I said, that's great, but how are you set up for taxes? I'm an LLC. An LLC is not a tax entity. There are 4 tax entities, and they are the sole proprietorship, the partnership, the S Corp, or the C Corp. Okay? Now, the thing with an LLC is your LLC can be any one of these items, depending on what paperwork you file or what paperwork you fail to file. Okay? A multi-member LLC defaults to being a partnership. A single-member LLC defaults to being a sole proprietorship. Okay? That's how that works. Now, why do we start and say the proper tax entity is number one? Because, guys, the amount of taxes you pay has more to do with these guys right here than what your deductions are. Okay, because this determines what part of the tax code that you are going to come under. Now, let's talk about this. If I'm going to be a sole proprietor, meaning I'm keeping things simple, I understand that I'm going to pay a large amount of tax because of this thing called self-employment tax. Now, the sole proprietor, here's my rule of thumb. If you are netting your income less than $30,000, it's okay to be a sole proprietor. If, however, your income is over $30,000, now it's time to make an S Corp election. Well, Roger, I've heard there's great things and low tax rates in the C Corp. You don't start out as a C Corp. This is a no-no. Yes, it has a 21% income tax rate, but we only use C Corps in very specific circumstances. So this one's pretty much going to be a no-go. So let's talk about what most small businesses need to be, and that is an S corporation. Why do we need to be an S corporation? Well, it's all about avoiding the self-employment tax. So let's take an example. Here, I'm a sole proprietor. Over here, I'm an S corp. Okay. And let's just assume that I made $100,000 of net. Now, I'm going to go ahead and tell you, in both the sole proprietorship and the S Corp, you're going to pay the same amount of tax on the $100,000. Okay, that's income tax. Here's the difference. The sole proprietorship has a 15.3% self-employment tax. But Roger, I got all kinds of other deductions, itemized deductions. Doesn't matter. This is paid on the bottom line of the business. So if you made $100,000 over here and we have a 15.3% self-employment tax rate on the full bottom line, that's $15,300. Whether you owe a dime in income tax or not, you owe $15,300 to the IRS for self-employment. Now, here's the difference. The S corporation, we're still going to pay income tax on that 100 grand, but we're allowed to split this up for payroll purposes. You see, I become my own employee when I am in that S corp. And now I can pay myself a salary. And according to my handy dandy chart, I would have to pay a salary of $40,000 on this $100,000 over here. And now that 15.3% only applies to the $40,000. But now it's not called self-employment tax, it's called payroll tax. So now this math works out to be $6,120. So I have gone from 15.3 to 61.20, and that has now saved me $9,180. And all I did is file an S Corp election and absolutely nothing else. Then we can start doing other deductions. Well, Roger, I've got more than one person, so my partnership should be an S Corp, right? You would think so, but the answer is no. This is what I see when most people come to me. Here's their partnership. It's in an LLC, okay? And they own it. This is them. And this is you. Looks like I just activated my eraser. Let's fix that. There we go. All right. This is you. You personally, as in under your social security number. All right. We're not going to worry about them. We're worried about you right now. So could you make an S election here? Yes, you could, but you should not, because what is best for you tax-wise may not be best for your partner. And if you are holding this as you, guess what? It's a partnership. That partnership is also subject to the self-employment tax, just like the sole proprietor is. You're going to pay 15.3%. But this is how you avoid this. You don't make this an S Corp. You own it with your S Corp. Now, all this partnership is a conduit to funnel your money to you. You pay your salary on your part of the earnings. You avoid your self-employment tax. Now, if your partner's smart, he'll do the same thing. But here's the deal, guys. You never enter into an S corp that your partner is not your spouse. All right. If your spouse is involved, it can be an S corp because that doesn't screw up any of our tax planning stuff. But if you're partnering with someone else, you need to have a partnership here and then own your share of the partnership with your S corp. Okay. Now we're ready to start doing what? Deducting. And now we can get in here and we're going to take our operating expenses, our office supplies, our technology subscriptions, all this other stuff. Now, we're also going to start deducting travel. And hey, guys, I've got a wealth of videos that explain these things. We're going to use the Augusta rule to rent our primary residence to our business, deductible to the business, non-taxable to us, and we can do that for up to 14 days each year. I got another video on it. We're also going to take the home office expense. Now, home office is not very much, but if you start your day and end your day in the home office, you have the opportunity to make all the miles that you drove during the day deductible. Home office is a gateway. Okay. Now, let's say you have children or grandchildren or nephews or nieces. We have strategies to pay the children. Now, there's a very specific way that it has to be done. And if you do it right and they are under 18, you're going to avoid Social Security and Medicare. There's no W-2. There's no 1099. The kids won't have to pay any federal tax. Depending on the state you're in, there may be some state tax. But this is the children pay strategy. I've got a video up there on how that works. And we can have some solo 401k strategy where you can put between 66 to 80 something $1,000 a year away. Depending on your age. And we have some options. We can take deductions and make them traditional, or we can move this money into this wonderful thing that we call Roth. We don't get a deduction up front, but you know what? We're never, ever going to have to pay tax on it when we pull the money out. Guys, this is just the basics. These are pure, absolute basics. Now, once you have started building wealth and building assets, then we can get into some advanced stuff. There's things called CRTs. That's a charitable remainder trust. There's also things called CLLCs, charitable limited liability companies, or a limited liability company with charitable intent. There's also private foundations and a wealth of other things such as cash balance plans, 401h, things that the ultra wealthy up until now have only been able to take advantage of, but now they're being expanded to where as you build net worth, you can play too. All right. I'm going to wrap up here on the whiteboard and we'll kick it back to the main camera and we'll wrap up.
Hey guys, thanks for joining us today. I hope that you have enjoyed the last few minutes here talking about maintaining your money, keeping it out of the hands of Uncle Sam and keeping it away from lawsuits. Two very important things if you're going to build long-term wealth. Now, don't forget, that book is coming out and the webinar is available. Just mention in the comments if you want more information and we'll get back to you. Till the next time, Roger out.